Right, good morning everyone, and thank you very much for joining us. We're now a couple of minutes past 9:30, so I think we will make a start. By way of just a very quick introduction, I'm Peter Mills. I'm a senior manager in the business tax team at Menzies. I specialise in corporate reconstructions, but I also regularly advise on the tax implications of buying and selling businesses, exit planning, and that includes transitioning to employee ownership. So having an exit strategy is something that will inevitably be relevant to all business owners, but conventionally we've thought about this in terms of a few core options. One of the most common being a trade sale or a sale to a third party. Alternatively, this might be a sale of the business to the next generation of management, a transfer or sale of shares to other members of the family who will take it over going forwards. In other cases, it might just be that the business is wound up. An alternative strategy that has been becoming more popular is to sell the business to all employees, and employee ownership trusts are a particular model for all employee ownership, and that is the focus of this morning's discussion. We've only got about half an hour, so what I'm hoping to achieve is to give a broad flavour of what that structure looks like, why it might be an attractive exit strategy, and then also talk through a couple of practical considerations that hopefully give an idea about how this actually works. It's not going to be possible to address questions during the presentation, but I am mindful we had a couple of queries in advance, which I'm hoping are covered in the core content already. If anyone has any other questions or wants to understand a bit more about this or any other options for exit planning, you can either drop a message in the chat box and I'll try and pick these up if we have time at the end, or the final slide has my contact details on it, and I'm happy if anyone wants to contact me directly afterwards. The webinar is also being recorded, and I believe you should all receive a link to that recording after the event, and that will also have my contact details on them if needed. So the concept of an employee ownership trust is one that derives from some specific tax reliefs that were introduced in 2014 to specifically encourage employee ownership. In overview, this is a particular type of trust that owns a controlling or absolute share in a trading company, and it owns those shares on behalf of the employees. The tax reliefs essentially mean that disposals to a qualifying employee ownership trust are tax-free for the selling shareholders. Although the broad mechanics of a trust owning a company theoretically works for a number of companies, it is worth noting at the outset that in order to qualify for the tax reliefs, there are certain conditions that have to be met. Firstly, the company must either be a trading company or the holding company of a trading group. That said, if a company does own a small amount of investments, that isn't necessarily prohibitive. And if there are more significant investments, some prior restructuring will often also be possible, for example, to break the various parts up so that an employee ownership trust can still be used as a strategy for the trading business as a distinct component. This is a model for all employee ownership, and so the trust has to be for the benefit of all employees. The trustees do have some ability to differentiate and pay benefits based on some very limited metrics, and the company still has the discretion to remunerate employees on commercial terms, but the rewards of being a shareholder, that is the dividends, the capital, those ultimately need to be shared on largely equal terms amongst the employees. The trust also needs to own at least the majority of the shares and to control the company. Quite often an employee ownership trust will acquire all of the shares from the previous owners, but in principle the shareholders can retain some shares, or other individuals can have direct shareholdings if they want or need to, as long as the trust has control. Notwithstanding, as I mentioned, the trust has to be for the benefit of all employees. Certain individuals who hold or have historically held shares directly in the company do still need to be excluded from benefiting from the trust. and there's also a limit on the number of employees who can also be shareholders. That's largely those who own more than 5%, in that they can't make up more than 40% of the workforce. As well as being relevant on the inception of the trust, these requirements do also need monitoring on an ongoing basis, because if the conditions are ever breached in the future, there are some subsequent tax consequences. If that's in the first year after the transition, this would result in a withdrawal of any immediate tax benefits for the shareholders. And if the breach is at any time after that, this essentially triggers a deemed disposal of the shares for the trustees. Because the trustees inherit the base cost of the shares from the old shareholders, this also essentially crystallizes any gains that the shareholders weren't taxed on at the outset. So that can have quite a significant tax impact, particularly where some of these circumstances might not actually create any cash. So in a strict sense, the tax relief does also only apply when a company is sold to an employee ownership trust. That said, there is no reason why this model can't necessarily work for other types of businesses, partnerships, LLPs, subsidiaries of a larger group, for example. The implementation process just requires a bit more planning. Some prior restructuring would be necessary, so it's a company being sold. For example, a partnership could be incorporated. That can often be done on a tax neutral basis. And then the shares in the resulting company would then be sold to the employee ownership trust. So how does a sale to an employee ownership trust then work? In very broad terms, this is actually quite similar to a number of sort of conventional disposals, except the buyer is just this trust. So once the trust is set up, this acquires most or all of the shares from the existing shareholders. Generally, there'll be an element of cash payable up front. There'll then be a debt left outstanding for the balance of consideration. The company would generally make an initial contribution to the trust so that the trustees can pay the initial consideration. Then further contributions will be made in the future, enabling the trustees to repay that outstanding purchase price. There are a couple of ways in which that can be financed. The most common means of doing so is out of the existing cash reserves of the business. That's to make the initial payment. And then as profits are made in the future, those can be used to repay the deferred consideration. Most commonly, the company simply makes gifts to the trustees out of the cash that it has available. But the company can, in principle, also lend the money or pay dividends to the trust. There just tend to be tax implications of those alternatives. There are also some lenders who I understand are financing employee ownership transactions. In principle, the trustees could borrow directly, or what I think probably happens more commonly is that the company will borrow the money and then make contributions in a similar manner, as I already noted. The process of borrowing externally can help expedite payments to the shareholders, but there are some practical challenges with this that it's worth bearing in mind. Firstly, the employee ownership trust rules mean that there can't be any arrangements in place whereby the trustees could cease to control the company. And so strictly that can limit the options in terms of providing security, particularly at the sort of trustee level. Lending against future profits is also considered relatively risky, and that means that there can be quite a high interest rate, which can place a sort of high financial burden on the company. And a number of clients that I've actually spoken to about this have expressed concern with exactly that prospect of handing a debt-laden business over to employees. And the trustees will also have to get comfortable that that's in the best interests of the employees, who they're ultimately acting on behalf of. So with that in mind, as I mentioned, the most common strategy is that the process is funded out of the reserves of the company, and the shareholders just need to be mindful that that can mean some compromise in terms of how and when the money will actually be received. As I also mentioned, it is also most common that the shareholders would sell all of their shares. This is partly because quite often those parties will want a full exit. It's partly also because the tax relief that I briefly alluded to pretty much only applies in respect to that first sale. But also, after the employee ownership trust has acquired the majority of the shares, the value of any residual shares potentially diminishes, because there's a reduced likelihood of finding a buyer for them. And the EOT also can't pay more than market value for shares, because that'd be seen as providing a benefit to a particular individual that would breach its constitution. And there's normally a discount in valuing a minority interest. That means a minority shareholding is not simply worth a percentage of the whole. So what are the benefits of this, and why might it work as an effective exit strategy? So firstly, and as I briefly alluded, there are some very attractive tax reliefs applicable to disposals to an employee ownership trust. In essence, where shares are sold to an EOT that meets the relevant conditions, there's generally no capital gains tax, no income tax, and no inheritance tax for the sellers. So it is essentially a tax-free disposal. This compares with a minimum rate of 10% that's achievable on most other forms of share sales. And that 10% rate is only applicable where business asset disposal relief applies. That's on a maximum of £1 million across the individual's lifetime. Otherwise, a 20% rate of capital gains tax generally applies. So quite significant savings potentially by selling to an employee ownership trust. Employees of an employee ownership trust owned company can also be paid up to £3,600 in tax-free bonuses a year. So there are some wider benefits to the employees in that respect. And there are also a number of sort of other commercial advantages. Not least, I think a number of owner managers simply really like the idea of passing the business on to employees. Those individuals might have been critical to the business's development. And this is seen as a way to recognise and reward that contribution. Some comfort can often also be taken from handing the business over to a successor group that the vendors trust, who already understands the business, and then, and as a way to sort of protect and preserve a culture and a brand that might otherwise be exposed if a third party were to be involved. That buyer is also readily available simply by virtue of the employees existing, and that saves on the process of having to search to find an external buyer, or going through what can often be sort of a time-consuming, very intense negotiation process that's often the case in trade sales. The nature of this sort of employee ownership trust buyer, bearing in mind it's generally made up of sort of people who are known to the sellers, also means it can be a bit more tenable for the sellers to withdraw gradually. For example, if they don't want to retire immediately, or if they want to oversee that transition, or oversee and monitor the process of their deferred consideration being repaid. In principle, there's also no reason why the vendors can't receive the full market value of their shares. And that would commonly be the case in respect of that initial sale to the EOT. That does come with a couple of caveats. Firstly, in that the nature of some other buyers might mean that a higher price might be achievable on the market. For example, if those people could achieve some economies of scale. And it does also need to be borne in mind that the way the trust pays for the shares generally does mean that the purchase price might be spread out over several years, and the shareholders will need to be comfortable with that. In addition to those, there are also some obvious benefits to the employees. Employees at all levels of an organisation can potentially feel part of the business to a greater extent. This might provide for a feeling of greater security, better engagement, hopefully altogether providing for a more productive and rewarding environment. A final point to note is that this structure is also very adaptable. And so it does resolve some of the other challenges that can be relevant in employee acquisitions. For example, it can otherwise be quite expensive for employees to buy direct shares. to buy shares directly because of the applicable tax implications. And I've seen a few cases where a company in its early stage might have a history of employees buying shares, but as the business grows and becomes more valuable, that just becomes unsustainable because employees simply can't afford to pay what they need to keep acquiring shares without triggering some income tax charges. Wider scale changes in ownership, like management buyouts, are also often debt funded, whether by the vendors, some kind of deferred consideration, or because external finance is raised to fund that. That needs to be paid off out of future profits in the same way. What often happens in MBOs, though, is that takes several years, and by that time, the new owners are then potentially thinking about their own retirement, and that starts a cycle in which the company's profits are constantly being tied up, paying off a previous generation of owner, meaning there isn't a great deal of cash left to invest in growing the business or just rewarding key people in real time. By contrast, once a business has been acquired by an employee ownership trust, that's potentially it. The employees themselves don't actually own the shares, the trustees do, and they stay owning the shares. The beneficiaries are then whoever the employees are at any given time. So in terms of how this works in practice, this is one of the common questions I get, actually, is how this works. And I'm conscious the governance arrangements surrounding EOTs are a little bit unique, and I also appreciate not everyone will be immediately familiar with how sort of discretionary trusts work. So I thought it might be useful just to touch on this briefly. In summary, there are essentially 4 layers of ownership and governance in the structure. Firstly, the shares are actually owned by the trustees, who are essentially the people who look after those assets on behalf of the beneficiaries, i.e. the employees. In theory, the trustees can be anyone, although there are some sort of theoretical risks associated with being in that position. And so what commonly happens is that a separate company is established and that company is appointed to act as trustee. It then has its own board of directors who essentially act as de facto trustees, but with the benefit of limited liability. Best practice is that then that board of the trustee company, who essentially act as the trustees, is composed of a mixture of people, senior managers, directors, employee representatives would normally sit on that. The previous owners can also be on the trustee board. That would be quite common so that they can remain involved in that transition, although they should never make up a majority. And there should generally be at least one independent person on that board as well, who's sort of just there to provide some objective input, particularly where it's unavoidable that some of the other parties might sometimes find themselves with some conflicting sort of objectives personally. The company then still has its own board of directors who are responsible for operational control and the day-to-day decision making. The fourth group of people are then the employees, who are the ultimate owners, but they don't actually own the shares. They don't necessarily have any direct involvement in running the business that they wouldn't ordinarily have. They just share in the economic benefits. Although on face value, the various layers of this can sometimes seem a little bit cumbersome and potentially a bit scary, I think practically there probably isn't actually a lot different from this from other models of internal succession, in that there still needs to be someone or a group of individuals who can run the business after the shareholders have exited. They'll need to be identified and on board with it. The employees, they'll carry out whatever their roles are. There'll just be some wider processes alongside that for them to have more visibility, some direct channels to contribute to those more strategic decisions, and the ultimate economic rewards are shared amongst them rather than a specific group of shareholders. One of the questions that was actually asked in advance of the webinar actually was what sort of size of business employee ownership works for, and I think there can often be a perception that only larger businesses can sustain these processes. But from the research that I've sort of read into employee ownership and my own personal experience, I think it's all kinds of businesses that have actually made this work for them, and that ranges from the hundreds of million turnover businesses like John Lewis, who we'll all be familiar with, but all the way down then to a number of £1 million turnover businesses with 20 employees. The key thing I think is relevant is whether, well, firstly, whether the structure actually works for the sellers and whether they're happy with the way they get the money, but also then, is there the appetite and the skills within however many employees there are to make it work? Can someone run it? Will this actually achieve the level of employee engagement needed? And I think it's those sort of factors that tend to be more important than just how big the business is. And then the governance structure can be built around that. So although not necessarily a direct part of how this works as an exit strategy, a further and final practical point that often comes up in discussions is how the trust actually provides these benefits to employees once the structure's in place. As I mentioned, employees don't actually own shares in the company, so unlike in conventional ownership models, they don't generally benefit directly from dividends or from the prospect of selling shares and realizing capital gains. In principle, the company can pay dividends to the trustees, or the trustees could sell some shares as long as they always keep that controlling interest, and they can then use the funds to provide benefits directly to employees. That said, any benefits that the employees do receive arise to them by virtue of their being employees, and so will always be taxed as employment income, so subject to income tax and national insurance. There's also a possible layer of immediate tax for the trustees as well, depending on how they get the money in the first place. Particularly for capital gains, that's got a high burden of tax, which is one of the reasons why this tends to need to be a long-term model, because there's a bit of a disincentive there to the trustees ever selling the shares because of that applicable tax treatment. Because any benefits that are paid out of the trust are subject to income tax anyway, and there's a little bit of complexity associated with the trustees handling that money in the middle, more commonly employees will simply be remunerated and profits shared by the company paying bonuses. As I mentioned, one of the advantages of the EOT model is that all employees can receive up to £3,600 of tax-free bonuses a year, as long as that's paid on equal terms to all eligible employees. Whilst that might seem like a relatively small sum, the feedback I've actually had from people who've sort of got this model established is that it can actually be really valuable to a number of employees, and does actually really entrench that feeling of everyone being part of this business. That can also then sit alongside a bigger bonus scheme to share profits more widely if appropriate. What these sort of arrangements don't necessarily do, though, is provide a particularly effective way to remunerate specific employees who, even though they don't own the business, will still inevitably be a critical part of it. And someone ultimately needs to be there to provide that senior leadership, the oversight, the direction, so the board of directors, the senior management. And so a final key consideration before moving to employee ownership is just understanding how that more specific part of the remuneration process needs to work. Aside from the tax-free bonuses, which, as I said, have to be paid to all employees, the company can still pay salaries and ordinary bonuses flexibly on commercial terms, and that doesn't need to be sort of equal amongst everyone. The most straightforward way to deal with those key individuals is that way, through targeted bonuses, and there's no reason necessarily why that can't be tailored to some sort of specific objectives, whether that's linked to profit, whether it's linked to share value, in the same way as a sort of phantom share scheme might be. Regularly, those sort of arrangements will be sufficient, but I am aware this can be perceived as being a bit restrictive, and potentially seen to put employee-owned employers at a disadvantage to competitors who might actually be able to offer shares to employees. In principle, it is also still possible to have some form of equity of share incentive scheme running alongside an employee ownership trust. In theory, that can also be one of the tax advantage schemes like the EMI scheme, which the scheme rules specifically allow. This just needs a bit more careful management to ensure that whatever scheme does go in place doesn't breach those requirements that I mentioned and cause some wider issue. The trust ultimately has to retain control of the company as well to avoid that withdrawal of the tax reliefs. And as I mentioned, that can act as a sort of disincentive to a full company sale. So there isn't necessarily an immediate market for employees to sell their shares, even if they can get them. There are also then potentially some limitations on what the EOT can pay for those shares itself, as it can't be perceived to provide any benefits to sort of specific or specifically excluded individuals. So as well as putting in place that scheme that actually works, this needs to be complemented by a wider strategy to then ensure that those employees are actually able to realise the value of the shares. And in that sense, we'd often look at ways to create an internal or sort of artificial marketplace, whether using the EOT itself or another purpose-specific, more general employee ownership trust that sits alongside that structure and is specifically there to buy and sell a pool of shares from employees. So hopefully you've all found that useful as a very high level, albeit I appreciate quite broad overview of what an employee ownership trust is and how it might work as an exit strategy and thereafter. I appreciate this won't be for everyone, but in the right circumstances, this can be a really effective strategy for selling a business and also one that leaves a sort of positive, lasting impact. For anyone who does feel this might be for them, the first step before transitioning, I would say, would generally be to weigh up in a bit more detail what this model looks like compared with some of those alternative exit strategies. A key part of this is to make sure that it can work financially and that the payment profile for the sellers is acceptable, but then also to try and build a plan for those practical aspects in terms of how this will work going forwards, who will run it, and how to make sure that it has the most effect on employees. This is something that Menzies can support with. We regularly help both in terms of assessing the feasibility of the structure and in modelling financially how this works for the various parties. Once this has then been established as viable, we would normally go through a more comprehensive process of putting together a framework for the structure, valuing the business, modelling that financial strategy in a bit more detail, doing a detailed plan for implementing the structure. There are some clearances we would normally obtain, and there's also that final piece in delivering this to employees to make sure they see and understand the benefits and how it needs to work. So that's all of my prepared content. I think in the moment you'll all have an opportunity to fill in a quick poll. If you would be interested in talking through any of the specifics of this in a bit more detail or any of the alternatives, please fill that out and we can come back to you if you do want some more information. Right, I think we have had a couple of questions, so I'm just having a look through those. Right, so one of the questions we've had is, what happens if an employee who owns through an EOT wants to leave? Do they sell back to the EOT or effectively walk away? So this is a really good question, and as I mentioned early on, this is actually one of the attractive things I think for me of this structure. The employees themselves don't actually own shares unless there's a sort of separate scheme to enable them to acquire their shares, which would be an entirely separate discussion. So the trustees own the shares. The trustees own the shares on behalf of the trust, and the trust is for the benefit of whoever the employees are at any given time. So if an employee leaves, they never had anything to be taken back off of them, so they do just leave and they walk away from that value altogether. Hopefully that does clarify that, but if I can provide any sort of further guidance, feel free to just let me know. So, more questions coming in as we speak. Does the trust have to register with the tax registration service? Yes, and it does have to pay tax, but generally it will only pay tax on things that it receives, and quite commonly benefits are provided to employees by the companies through those sort of bonus arrangements. So the actual obligations for the trust can be kept relatively minimal. So does holding a large amount of cash in the target create an issue? It could do if the value of that cash was really significant, but actually generally that can be quite helpful because it would be factored into the value, and as the company makes an initial contribution to the trust to pay the first tranche of the purchase price, actually having some cash in the company can be helpful to sort of make that payment a bit more appetizing to the shareholders. There are still questions in, so I'm going to answer the next one on my list, and then I might have to come back to people afterwards. How many EOT schemes have been set up? It's quite a good question, and I think the latest statistics that I was receiving on this were a bit confusing, but it's somewhere between 500 and 1,000 now, and I think more than half of those were in the last 2 years. So there are now a lot of these out there, and they are becoming more popular. So I think we're running a bit short of time, so I'm going to sort of finish up there. If I haven't answered any questions, or if anyone wants to talk this through in a bit more detail, my contact details were on the screen, but I believe they are currently hidden behind the poll. Nope, they are still there. So if anyone does want to contact me, feel free. Otherwise, thank you all very much for attending. As I said, hopefully you found that useful, and hopefully we'll see you on some other webinars in the future.